Welcome to the Money Over 50 podcast, brought to you by Dallas Davison and Michael Hogue from Money Over 50 Financial Advisors. This information is general in nature and does not take into account your objectives, financial situation, or needs. Therefore, you should consider whether the information is appropriate for you and your personal circumstances. If you require personal advice, please contact Money Over 50 Financial Advisors. Here are your hosts, Dallas Davison and Michael Hogue.
Welcome to Money Over 50. Today's topic, small business capital gains tax concessions.
Dallas, I've wanted to do this one for a while, and I've resisted that.
I know the feeling, Michael. I've been in the same boat.
For a couple of reasons. One is it probably will only suit a small number of our audience.
Yep. So we apologise in advance. If you don't have a small business, this may not be interesting, or it won't be relevant. It may not even be of any sort of interest at all.
I'm sure there'll be listeners out there that will still want to listen to this because it is quite interesting.
Yeah.
I've heard it referred to as the most generous tax concessions in our country,
system,
and I believe that.
I'd agree with that. Yeah.
I certainly agree with that. So, what it's really pitched around is if you run a small to medium sized business, and it doesn't have to be that you're selling the whole business, but it usually is. If you're selling the business closer to your retirement, for a lot of people, the capital gains, number one, the capital gain that is incurred from selling your business, and we'll go into some examples there, is disregarded up to very, very generous limits.
Yes.
And number two, the second benefit of that is that you can actually get a much, much larger amount, including up to the entire sale proceeds, into your superannuation fund.
Yep.
Which, by the way, is exactly where you want to end up with that money.
I was going to elaborate where you go. There's nothing magic about getting it into super, but if you've been listening to this podcast for any extended period of time, you would have heard us talking about the different earnings tax rates in retirement and how super can be really advantageous. And so, that's exactly right. I guess a great place to start. Those are really the two benefits, and the two sort of separate benefits is that both around minimising tax. The first one is that you're minimising capital gains tax. So potentially can be completely disregarded and not pay any CGT on the sale of your business, and we'll go into other types of sales that can work here. And secondly, as you said, you can get much more of that compared to normal into superannuation. The earnings tax on that is likely to be far less than the amount that you would incur if you then had that in your own name and had to invest in your own name. So. Did you want to get started on?
We'll use some examples. So there are plenty of pass-throughs as well, and what I mean by that is key conditions that you need to meet. Yeah. Now they're not entirely difficult conditions to meet.
No.
However, there is quite a few of them. So let me just preface this with: we're not going to get through everything today.
This is why we've resisted doing
this. This is why we've resisted doing that.
It is very involved, and so do not. I mean, there's always the warning at the start of this, but do not take this as personal financial advice. Everyone's situation, there are, like you say, there are about 10 different boxes that need to be ticked for every different variation of this strategy. And if you don't tick every box, you can come unstuck. So this is just, like we said, we'll give a few examples to give people a bit of an idea of what's out there and what's available. But if you think this is relevant to you, you really need to look at this and based on your situation.
It's a situation to do much more research after this, and we'll talk about where to go to get that research. But basically, it's one of those things. If some of these examples are similar to your situation, you're running a small to medium business, then and you're thinking of obviously selling it at some stage, which most people do when they are approaching retirement, then certainly this could be it's a significant tax saving. It's a significant planning tool that we use with our clients who are in that situation. So first of all, look, it has to be what's called an active asset.
Yes.
So a capital gains tax asset is an active asset if it's used in the business of the owner, an affiliate, spouse or a child under 18 or a connected entity. I mean, most of the case, it's just used by the owner.
Yeah.
So it's either your business, you run it as a sole trader or a partnership. It can be a company, it can be a trust, it can be all of those things. The key to this is that it has to be an active asset.
It has to be run in connection with a business, basically.
And so common active assets are business goodwill. So that's my business on paper is worth not much, but what its saleable value is much higher because it's got X amount of profit each year. So that is a CGT asset. You would pay capital gains tax on that if you sold the business. That's an active asset. The business premises is an active asset. So if you're building that you run the business out of, that is also an active asset. And what are also assets or active assets are depreciating assets such as plant and equipment. That's a good one because if you buy a truck, if you're in a trucking business, you buy a $100,000 truck. What happens is you claim depreciation on that truck every year. This is a simplified example, but if that depreciation rate, accountants might shoot me down here. It used to be 22.5%, I believe. So the truck in the first year loses on paper $22,500.
Yes.
Now the value over time of that truck goes down to zero.
Yeah.
You sell the truck for $50,000, for example. That's a capital gains tax event, and you would normally pay tax on that sale.
Yeah.
So business goodwill, these are the common ones. They're more than this.
Yep.
There's business premises, and then there's depreciating assets such as plant and equipment.
So I think this is probably a good opportunity to things that don't meet the criteria. If you just own an investment property, for example, whether that's a residential property that you own and then you sell that, it's not an active asset. It's not held in connection with a business. It's not used in the running of the business. That's the case even if you own a commercial property, but it's leased to a third party. It's not used in. If you have a business,
I have an unbelievable example here.
Beautiful.
So a prospective client came to see me the other day. Someone that I've known for some time. They have 2 blocks of land. So right beside each other. One is rented out to another business, so that would be counted as a passive asset. The other block is used in the business for all the business-related purposes. So essentially, to in the carrying on of the business, it's a trucking business. So he has an offer for sale. An offer to buy these blocks of land. They're about $1 million each. And they were bought for about $100,000 each some time ago. So 2 very different assets here. The active assets, the block that's used for business, on $1 million sale, there's a $900,000 capital gain. So meeting the exemptions that we'll get to later on, the $900,000 capital gain is disregarded in this situation because it's an active asset of the business, so it's used in connection with running the business. So effectively, that capital gain is firstly disregarded, which we said was obviously a good thing.
So benefit number one is they just don't pay that capital gain tax.
They just don't pay any capital gains tax on that capital gain. Secondly is that they can actually put the capital sale proceeds, not just the capital gain, they can put into superannuation.
The full $1 million.
So the full $1 million can go into superannuation right before they're ready to retire, which is, as we just said before, and we've a recurring theme of our over 100 podcasts so far, as that's where you want your assets to end up. So that's the second benefit. You can actually get that money in. It doesn't come under the standard non-concessional contribution caps, which are still $100,000 a year at the moment. So it's not caught up under that. You can get a large whack of money into superannuation. The block next door that's been rented out, and its sole purpose is only ever be to be rented out. Virtually the same sale price, $1 million, same capital gain. They bought it for about the same amount. So what happens now is that because it's a passive asset and it's not used in connection with the business, it was just used to be a passive investment and get rent from, the $900,000 capital gain on that passive sale on the block next door is capital gains tax assessable. Now, they've owned the block for longer than 12 months, so that is half. The $900,000 capital gain is half to $450,000. And they're a husband and wife. They're set up as a partnership. But what happens is that $450,000 goes to them as taxable income.
Yep.
So it's as if they've earned $450,000.
So there's a $900,000 capital gain. They get the 50% 12-month discount. So there's $450,000 worth of income that flows through to them personally as partnership. As partnership.
So effectively, $225,000 of taxable income per person, and the tax that they would pay at standard marginal rates of tax is $76,417 in tax each. So together, it's just a little bit under $153,000 of total tax. So you can see very different.
Yeah, so basically exactly the same assets. One's an active asset, one's not an active asset, and the tax bill is either $150,000 or $0.
It's a big difference, and
part two
of that is that it now becomes difficult for them to get all of that money into superannuation. So they've sold a block for $1 million, the passively rented block. They've lost $153,000 in tax, and that's left them with $847,000. It can be hard to get that money into superannuation for them. Now, these guys will be able to get some of that money in, but in the first example, it's of the active asset, $1 million sale, capital gain of $900,000 disregarded because they meet the 15-year exemption. We'll talk about it in a little minute, and that money can go straight into superannuation as well. So it's a double whammy if it counts as an active asset. Capital gains is disregarded, saves them in this case an extra $153,000 in tax.
Yeah,
because that's what they paid on the identical block, except that it was being rented out over that period of time for passive income. It saves them $153,000 in tax, and also they can get the money into superannuation as well.
So they basically they pick up that huge tax saving as the one-off, and then in addition to that, they've got a higher amount. They've got the full $1 million inside super. We won't go into all that in detail, but obviously if they're going to retire, potentially they can move that into an account-based pension and pay no tax on the earnings on that money ever again. So they pay no tax on the capital gains, no tax on the earnings on that money, compared to the passive asset. They're left with $850,000, and then the earnings on that are added to their taxable income each year potentially. So, that's. I mean, like we said, what we could have gone into great detail in this podcast about all sorts of different strategies and the rest of it, but I think that's a really good example of the benefits of this and showing, the twofold effect of that, minimising the capital gains and being able to get more than normal into super.
Yep, and it's available for all businesses. Now, you do have to meet some turnover tests here, which we'll go through.
Yep.
And farms as well. So farming is a common one here, Dallas, that you see.
I've done this a few times. It's a very, very handy one for the cattle farmer.
Yeah. So some other basic eligibility that needs to occur. Number one, that a capital gains tax event has occurred and a gain would have resulted, which is standard most of the time. The asset meets the active asset test, so that's a fairly broad test. It's just that the active asset, to be an active asset, it had to be used in connection with the business. So I won't digress too much. There's been a court case that's gone through recently where Eichmann had he was a builder and had a block of land and used only part of it as in connection with his business for a period of time. So I said I wasn't going to digress, but there is an update coming with that. But basically, the court, the federal High Court, I think it was, had ruled in favour with him as the taxpayer as opposed to the ATO.
Yeah. There's a lot of case law with this whole area, and that's kind of what we talked about. It is a bit of a grey area. A lot of definitions of things. You hear a lot about people who are doing this. They'll go to their accountant and get a private ruling because it's not black and white as to, is this an active asset? Is it not? Well, some bit of it might be, some bit might not be. Is it in connection with their retirement? Well, what does that mean? And what does retirement like? There's all sorts of every sort of step along the way. It's a bit of a grey area, and you sort of have to be able to work out or decipher what that actually means, and then whether you meet that criteria. So, like we said, it is a real area where you do want to get it right, and I have heard of a lot of people that go and get private rulings from the ATO around this and make sure that they do meet all the criteria before you go ahead. So
the other one under a basic eligibility condition is that only one of the following applies. So there has to be a $2 million maximum turnover test of the entity. Or a $6 million maximum net asset value test of the entity or the shareholders. Now, it's only one of the two. So, for example, if the business was turning over $2.5 million a year, however, they looked at the in this case, let's just keep it simple, it's a partnership between husband and wife, and that their net asset value test was less than $6 million, then they would qualify. They would qualify here. So it's one or the other. Now, so either under $2 million of turnover for the entity, and entity is, I guess, the correct word because it could be a company or it could be a trust as well, and under $6 million net asset value test. So it's one of the following. So a lot of businesses would qualify for that. There's a couple of other things that aren't counted as well, so such as personal use assets, boats and things like that. The family home and superannuation balances. That's pretty generous. So you could have $1 million family home. You could have $1 million each in superannuation. And let's say $1 million boat. God knows why you'd want that, but if
those things are not.
All right, if you had that, and you had that wouldn't be counted as towards the net asset value test.
It is an interesting one to me, this whole area, because like you said, it's seen as one of the most generous forms of tax savings available, and I think it sort of flows through with everything, because the fact that a lot of these definitions are a bit of a grey area, and it seems like a lot of things, as you step through it, they sort of err on the side of the taxpayer rather than the ATO, which is not the normal way that it feels like in most other areas of tax. It's like, if in doubt, the ATO wins. In this area, it kind of seems to be that if it's a bit of a grey area, it's like, well, those assets aren't included, and what does it mean to say that it's in connection with retirement? Well, you can sort of get away with the fair
Interestingly enough, in the Eichmann case, the lower courts ruled in favour of the ATO, and I think it was the full federal court, I think it was, ruled in favour of the taxpayer and said, for the avoidance of doubt, in any future situation, it should be ruled in favour of the taxpayer, not the ATO.
Which is very interesting to me. But I think that's I guess there's and we've talked about obviously the title of the Small Business Capital Gains Tax Concessions. There are actually a few different ways. We've used one example here. The example we've used is using the 15-year exemption. However, there are, and that's, I guess, where I say it's a really generous area of tax legislation, because there are more than one. There is not just the one tax concession. Like we've talked about the 15-year exemption, but if you don't meet the criteria of this one, then there's actually a couple of fallback ones as you go along, which is
So this is a hard point to get across on a podcast as well, because there's what Dallas is referring to there. I would probably call them levels.
Yes,
levels. So the first level to look at is, do I qualify under what's called the 15-year exemption? So this is separate to all the other criteria that we've talked about.
Yep.
So basically, let's assume that you've met those other criteria. You've sold an active asset. You've sold your business. For you have less than $2 million turnover or less than $6 million of net assets. The first level of this that you'd want to qualify for would be the 15-year exemption. So that's basically that you've owned. It says the asset, but let's say the business. You've owned the business for longer than 15 years. Yeah. For a lot of people, when they're selling, they would have owned a business for longer than 15 years, especially if they're selling it for a significant profit. I mean, not all the time, but 15 years tends to fly by. And if you've been in business, for some of your life, and you're at the point in time where you're retiring, very often you would have had that business and had that asset for 15 years over that period of time. So basically what happens is that to meet the 15-year exemption, the CGT concession will exempt up to 100% of the capital gain from an active asset that a taxpayer has owned continuously for 15 years. Some other conditions are required, such as that the taxpayer must be at least 55 years of age and disposing of the assets in connection with retirement.
Yeah, and that's, I guess, I actually have looked at this just recently with a client. It's a good example of one where it's sort of a bit of a grey area, because obviously being 55 years of age is not a grey area, but disposing of the assets in connection with retirement, there's a lot of situations where there might be a partial sale of a business, and they might be continuing to run the business, but the sale has been a part of a phased sort of sell-down strategy, and depending on when the sale occurred and all those sorts of things, you can basically sell a part of the business or sell some of the assets. You might not be fully retiring right now, but you might still be able to. That might still be deemed as being in connection with retirement. And
that very situation, with a farmer or a grazier,
with a grazier that was basically selling half their property.
Yep.
And that was the criteria. It was I won't go into all the detail, but we basically had to check. They were 55 years of age. They'd been running it for more than 15 years, but they were only selling about half of their property.
Yep.
So that was the question: if you sell half the property, is that in connection with retirement? What does it have? What do they have to? There's all criteria then about. Has there been substantial changes to their working situation, to all these sorts of things? So, but for them, it was obviously we went to their accountant and they looked at that in great detail, and they were able to access that, so they could meet that 15-year exemption, even though they were continuing to retain some of that property. So, that's where I guess I say the good thing about it is, so that's the 15-year exemption. And so, sorry, before I go into the other examples that I've got here, I'll just let you finish there.
So essentially, if you qualify for the 15-year exemption, to get money into superannuation, there's another figure that comes up, which is called the Lifetime Cgt Cap. And that's actually, right now, this gets indexed as we go, but in 2020-21, the Lifetime CGT Cap is $1.56 million each person. That's qualifying. So what that really means is that up to $1.56 million of the sale can go, if you meet the 15-year exemption, can go straight into superannuation. So no tax paid on the capital gain from that sale. And $1.56 million can go straight into superannuation. No tax is levied on the way in to superannuation.
Yep.
And the real hidden gem is that you've actually been able to get the money into superannuation at that point in time. So if you look at a husband and a wife that's structured as a partnership, or even if they're structured as a company and they own 50% of the shares each, basically they could have sale proceeds of the business of up to 3.12 million, and effectively then those sale proceeds, 1.56 million, can go into each of their superannuation funds. You can get the money in. You'd never be able to get that amount of money in, without without this
Meeting
without this concession. B is that there's no CGT to pay at all, no capital gains tax to pay.
Yeah.
C is that there's no 15% tax levied on the way into superannuation because the money just goes in completely tax-free. D is that you could already have significantly higher superannuation balances and you can get the money in. So you could
normally there's a with your non-concessionals, there's the total super balance issue there, where once you get up to those limits, which actually just go up to 1.7, you can't make extra after-tax contributions into super. But this, like you say, these sorts of contributions don't get caught up under that. So even if you've got $2 million in superannuation already, you can actually make more under these CGT concessions.
That's a good example. The one I was going to use, this couple has done all the right things as they've been running business for 25 years.
Yeah.
They've got $2 million of superannuation balance each. They normally they wouldn't be able to put in any money.
Yeah.
And they actually wouldn't have been able to put in any money for a while as a non-concessional contribution.
Yep.
That only would have been able to put in each year their $25,000 concessional contribution. They can pop $1.56 million straight into their superannuation balance, and they've got $3.56 million each. Now they wouldn't be able to open a pension,
with that whole amount,
like a superannuation income stream account-based pension, with any more than $7 million from the 1st of July 2021.
Yeah.
However, the rest of the money would have a maximum rate of tax of 15% on that. And so it's really generous one.
And there's a bit of planning around that as well. With I'm actually looking at that at the moment with a client where a couple potentially selling a property, and what we sort of want to do is build up one of their super balances right up to that total super balance limit of it's about to go up to 1.7. And then push all of the sale proceeds in on top of that bit.
There are many ducks here, and they need to be lined in a row, is what you're trying to say to us here.
It is. Even that's within that. There's some planning around, like if you're selling a business in phases, what you could potentially do is sell a portion of it into, basically direct some of the sale into as non-concessional contributions into someone's account, then push some of these CGT contributions into their account to max out what you've got into there, and then flow it back across the other one. So I won't. That's probably going to blow a few minds. But there is some planning around
what we actually do when this suits one of our clients or a prospective client coming to see us, we lock ourselves in a room for at least a day, don't we? with a big writing pad.
Yeah.
And you're just strategizing. You've got this writing pad. You're drawing circles. You're drawing cash going in here, and you're getting everything in a row. You're scrubbing some steps and pushing them back because you have to be able to make it all flow through. So it's all about bolting it all together and actually getting it into the right.
And that's
basically getting all of those steps in a row, because if you make what you're referring to there, if they pull the trigger on the small business capital gains tax and get that money in first, up to this $1.56 million each, and then sell a passive property that they can't get that money into superannuation at that point in time. Exactly. If they do it the other way around, they sell the passive property first, they can get that money into superannuation, and then they sell the business assets and are able to use that on top of that money that's already gone in.
I always laugh. People must be listening to this thinking, because we're now getting really excited about this. People must be thinking, you guys need to get a life. But this is really our idea of a good time.
This is a good time. This is like, so, on the sale of a $3.1 million business, if the majority of that was capital gains, then $3.12 million. If you didn't qualify under this, you would effectively, even if that gain's halved because you've owned it for longer than 12 months, you've got $1.5 million of realised capital gain. You've got $750,000 of capital gain each. Let's call that Let's call that about. Let's round it off at about $650,000 in tax to $700,000 of tax.
Right.
So
huge.
So you could volunteer that to the ATO, or you could do it this way,
and keep it all,
and keep it all.
Yeah.
But not only keep it all, get it into the most tax effective
pay no tax
environment for your retirement, which is superannuation.
And so that's a good point. As like we touched on it before when we sort of went back into the 15-year exemption. There's levels of this. So the 15-year exemption is one level that's available to you. If you don't meet the criteria of the 15-year exemption, there are other small business CGT concessions available. So, for example, there's the 50% active asset reduction, which is that you can reduce the capital gain on an active asset by 50%, which is in addition to the 50% discount for owning an asset for more than 12 months.
Yep.
There's a retirement exemption. So even if you don't meet the more onerous criteria of the 15-year exemption, you can be exempt up to a limit of $500,000 under the retirement exemption. There's a rollover relief as well. So to give you an example, I've got clients who are looking at selling a cattle property for $7 million. And so again, same thing. They were looking at selling it, but they went, well, we've bought it years and years and years ago for a very small amount of money compared to what they were going to sell it for. We want to sell it, but we feel like we can't because we're going to pay a huge whack of tax. Now, what we essentially worked out was they could sell the whole asset for $7 million, and once you applied the 50% 12-month discount, the 50% active asset reduction, then use the retirement exemption for each member of the couple, it completely wiped all of the capital gain that they would have been paying. So
this was an example where they didn't actually own that asset for. Well, it's been under 15 years.
They weren't 55 years of age.
And they weren't 55.
So they weren't 55 years of age. So they couldn't meet the 15-year exemption. Which, as you say, the levels of it are that if you can meet the 15-year exemption, you probably just do that first. Yeah. If you can't, there's a lot of
the other levels
to fall back to.
So we might come back with a part B of this with the other levels, but what we'll do first is see how many people have listened to this one.
if we get 10% of the normal listeners that we get, then we'll know. Okay.
Well, it's a funny one, this one, because even if there's only one listener to this topic, it could very well save them hundreds of thousands of dollars of capital gains tax. So, look, if this is something that is applicable to your situation, you do run a small to medium business, you do want to sell at some stage in the future, certainly feel free to book a meeting with us. Reach out to us at podcast@mo50.com.au. This is one of the situations where we work hand in hand with people's accountants, because there's a really, really important role the accountant plays, and there's a really, really important role that we play here.
Great point, Michael. I think that what I've seen when looking at this with clients is that, and we've talked about this before, even the best accountants tend to be focused on how to minimise that tax in that year.
Yes.
So I've seen a lot of this where, like you were saying, we lock ourselves in a room and strategise for a day about how do we minimise the capital gains, but how do we also get as much as possible into that tax advantage environment? How do we take advantage of all these different limits that are available to each member of a couple, all those sorts of things? I find that even a really good accountant should be liaising with the financial advisor, or the good financial advisor should be liaising with the accountant around not just how do we minimise the capital gains now, because we've seen this a heap of times where people come in and go, my accountant has said that I've met this criteria, I won't pay any tax.
Yep.
Well, that's great, but that's only one part of the puzzle.
Well, to use that example, a $3.12 million business has been sold, and the accountant says, okay, we can exercise the 15-year exemption.
You pay no tax.
You pay no tax on that, but it stops there.
Yes.
And we go, okay, well, that's fine. I get $3.12 million, but I have to invest that now in my own name or names, and I'm going to pay a lot of tax on that because it's going to be taxable income.
Yep.
Part B of that is where we say, no, well, because it's not a requirement to put that money into superannuation.
No, that's right.
If you're exercising the 15-year exemption.
Yes.
We say, okay, well, number one, that's save the capital gains tax. Part B of this, the hidden gem, is that if we can now get that money into superannuation and pay $0 in tax on that.
That's exactly right.
Assuming not assuming anything. If that was your sole balance in superannuation, which it is for a lot of small business people, they haven't put much money into superannuation.
That's right.
they both get $1.56 million into superannuation. They've only got a $100,000 balance each in this example.
Yeah.
All of that can go into 0% taxed pension phase.
Yeah, and that's exactly right. That's the exact example that I had with those clients I was talking about recently that sold the asset and was it in connection with retirement or not?
Yep.
That was they hadn't been putting money in super, so that that was exactly what we could do there, and that was they had talked to their accountant, and their accountant had said, you won't pay any tax on this, but like we said, it was then about going, well, you could save that tax now, but we also we're using that. That's, I guess, the big thing with why these concessions are available is that for most people who have been running a small and medium business, all of their energy, all of their finances, everything has been tied up in that business. And so what you're effectively doing is you're selling that asset. You then need that money to get dressed and get up and go to work for you.
I've finally got him to say it.
and you want that to be done in the most tax effective way moving forward. So it's really about, like you say, bolting it all together and getting all those pieces working in together.
Good place to wrap up. Thanks for listening today.
Thank you for listening to the Money Over 50 podcast with Money Over 50 financial advisors. We look forward to catching up again soon.